It is no secret that higher interest rates have really been a burden on the real estate market, not just talking about REITs, but also single-family housing as well, as the 30-year mortgage has reached an average rate of 8% or more, pricing out especially a lot of first-time homebuyers. However, the end of this rate hiking cycle is likely near the end. In fact, it could already be at the end, with the Federal Reserve in the last meeting deciding to keep rates unchanged. If you look here at the CME Fed Watch tool, it seems as if many believe the Fed will keep rates unchanged for the remainder of the year, with only one Fed meeting remaining in mid-December. When you look at the probabilities, which looks at various upcoming Fed meetings going through 2024 as well, odds are likely that the Fed is done hiking rates, which would be a release of pressure for the REIT sector. In fact, rate cuts are projected to start in summer of 2024, according to the majority. When it comes to investing, the stock market tends to move before the economy. The stock market's going to bottom out before the economy, and the stock market's going to top out before the economy does. As such, in today's video, we want to get set up for when rates do get cut, and that pressure release is given to the REIT sector. As such, we're going to take a look at 4 high-quality REITs trading at cheap valuations. In fact, 4 of these REITs that we're looking at are among my 4 favorite REITs to invest in. So with that being said, if you could do me a huge favor, smash that like button down below, subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me tell you about today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. Check out the link down in the description below. So again, interest rates have been a damper on the REIT sector, but we're gearing up and we're preparing for when rates get cut. As such, let's take a look at 4 REITs to look at before rates get cut, beginning with REIT number 1, which is VICH Properties. VICH Properties is among one of my favorite REITs. In fact, it's my largest REIT holding within my portfolio. The REIT is unique in the fact that VICH Properties is the largest landlord on the Las Vegas Strip today. And we're going to take a look at some of their amazing assets here in a second, but let's first look at the company as a whole. VICH Properties currently trades at a market cap of nearly $30 billion. Over the past 12 months, shares of VICH have fallen over 10%, giving investors a great opportunity to add to this high-quality REIT. As I mentioned, VICH is the largest landlord on the Las Vegas Strip. They don't just have properties on the Las Vegas Strip, they're across North America as a whole. And right now they have a portfolio of 54 gaming properties as well as 38 non-gaming properties. Here's some of their amazing assets along the Las Vegas Strip, which include the likes of Caesars Palace, Mandalay Bay, MGM Grand, Park MGM, New York, the Mirage, and the Venetian, just to name a few. The company recently reported their Q3 earnings, which were pretty solid. VICI beat on both the top and bottom lines pretty handily, with revenues increasing 20% and AFFO increasing 11% on a per-share basis. In addition, management also increased their full-year AFFO guidance as well. In terms of valuation, analysts are looking for the company to generate AFFO of $2.25 per share in 2024, which equates to a price-to AFFO multiple of just 12.4 times. For comparable purposes, the stock has historically traded at an average multiple of 16 times, suggesting a sizable difference at the moment. In addition to having an opportunity to purchase the REIT at a cheap valuation, you also get to enjoy a 5.8% dividend, a dividend that has been growing quite fast with an average dividend growth rate of 17.4%. Analysts are also high on the stock with an average 12-month price target of roughly $35 per share, implying 25% upside from current levels. REIT number 2 on my list is Simon Property Group, stock ticker SPG. Where we just looked at VICI, which is one of my favorite and my top REIT holding, SPG has been one of my longest REIT holdings. And for those of you unaware, Simon Property Group is the largest mall landlord here in the US. Simon Property Group currently has a market cap of roughly $45 billion. Over the past 12 months, shares of SPG are actually flat, meaning the REIT has outperformed the greater REIT industry. When it comes to malls, they are classified based on their retail sales per square foot. If a retail tenant is doing well, likely that entire mall is doing well. So when you look at the portfolio for Simon Property Group, they have an A-rated portfolio. Looking at this chart here, you can see the annual report put out by Corpaz Realty Advisors that updates the sales per square foot data with the proper classification. Wherever you line up in terms of your portfolio as a whole is the grade or the classification you give your portfolio as a whole. Simon Property Group recently reported their Q3 earnings, in which they tend to update investors on retail sales per square foot for the trailing 12 months. So, for the past 12 months, the company had retail sales per square foot of $744, which, when we look back at the classification report, gives the company an A-rated portfolio, nearly becoming an A-plus classification. So when we're talking about Simon Property Group and malls, we're talking about the best of breed, not malls that are closing their doors left and right. Those are C and D rated malls. Simon Property Group is the best they have. In terms of valuation, analysts are looking for the company to generate AFFO of $11.10 per share in 2024, which equates to a price to AFFO multiple of just 10.2 times. For comparable purposes, the stock has historically traded at a 5-year average of 13 times and a 10-year average of 16.5 times. If you thought the VICH dividend was great, you're going to love the Simon Property Group dividend. Simon Property Group currently pays an annual dividend of $7.60 per share, which equates to a dividend yield of 6.6%. The REIT did have to cut their dividend during the pandemic, but they have quickly grown it in the past few years alone. Analysts are also high on the stock, with an average 12-month price target of roughly $130 per share, implying nearly 15% upside from current levels. REIT number 3 on our list is Prologis Incorporated, stock ticker PLD. Prologis is yet another one of my favorite REITs, one that I own and one that I'm continuing to look to build a position in. Prologis operates in the industrial space, having warehouse and industrial properties. PLD has a market cap of nearly $100 billion, making it the largest REIT on our list today. And over the past 12 months, shares of PLD have fallen 5%. Prologis is an indirect play on the growth of e-commerce. E-commerce continues to grow year in and year out. And right now, e-commerce sales account for roughly 25% of all retail sales. And that number is expected to grow over the coming years, with further penetration from e-commerce. According to Prologis, e-commerce tenants use 3 times as much logistics space as brick and mortar. So as e-commerce continues to grow, it's going to be a tailwind for the likes of PLD. In terms of valuation, analysts are looking for the company to generate AFFO of $4.54 per share in 2024, which equates to a forward AFFO multiple of 22.7 times. PLD is known for much higher growth, and this year being a transition year, you can see the growth packed in to the following year of nearly 20% expected. For comparable purposes, the REIT historically has traded at an average multiple of 27 times, suggesting a decent sized difference at the moment. The REIT is cheap, it has some growth potential, but it also has a solid dividend backed by solid dividend growth as well. Very rarely do you find a REIT with strong dividend growth like we see with Prologis. PLD currently pays a dividend yield of 3.3%, the lowest on our list today. But in addition to that, they also have a 5-year dividend growth rate of 12.6%, the highest on the list today. The REIT has grown their dividend for nearly a decade now and counting. Analysts are also high on the stock, with an average 12-month price target of roughly $133 per share, implying nearly 30% upside from current levels. Are you new to investing or looking for a new brokerage account? Then definitely check out WeBull. Right now, if you sign up for a new WeBull account and deposit any amount of money, they will give you up to 12 free stocks, completely free, just for signing up and adding any amount of money. Definitely check out the link down in the description below. REIT number 4 on our list is Realty Income, stock ticker O. Realty Income, last but certainly not least. Very well known, a gold standard in the REIT sector, more well known for their monthly dividend. After all, they coined themselves the monthly dividend company. Realty Income currently has a market cap of roughly $37 billion, And over the past 12 months, shares of O have been under pressure, with the REIT falling more than 20% over those 12 months. Realty Income has a portfolio of over 13,000 properties, a number that's expected to grow with their pending acquisition of Spirit Realty, stock ticker SRC. The REIT is a retail REIT first and foremost, but they also have exposure to industrial, and they have been growing their exposure to gaming, which just tells you a little bit more about the strength of VICH properties. Realty Income is looking to step on their toes a little bit more, which tells you it's probably a good sector to be in. Over the years, Realty Income has been a fantastic REIT with a fantastic management team. But what has come into question over the past year has been their top tenants, their failing top tenants with Walgreens, Dollar General, and Dollar Tree. All three of those companies, if you look at their stocks over the past 12 months, have been getting demolished. Also, the REIT has been seeing their exposure to investment-grade tenants continue to decrease, and that's something that is going to decrease once they close their acquisition with Spirit Realty. However, I have all the confidence in this top-notch management team, backed by a strong balance sheet and a fantastic credit rating, which puts Realty Income at an advantage to their peers. Right now, with valuation quite low, which we're going to take a look at in a second, I've been using over the past few months little buys here and there just to add to my portfolio. I'm not going to continue to add and buy hands over fist, but for those of you who have been on the outside looking in, now might be a great time to start nibbling. In terms of valuation, analysts are looking for the company to generate AFFO of $4.15 per share in 2024, which equates to an AFFO multiple of just 12 times. For comparable purposes, the stock has historically traded at an average multiple of 19 times, suggesting a very sizable difference at the moment. Realty Income is one of only 3 REITs on the popular Dividend Aristocrat list, meaning they have paid growing dividends for 25 consecutive years or more. The REIT currently has a dividend yield of 6%, something we have not seen in decades, and it is a dividend that grows each and every quarter, not just year, but quarter. Analysts are also high on the stock with an average 12-month price target of roughly $60 per share, implying nearly 20% upside from current levels. So as you can see here, all 4 of these REITs are high-quality companies, high-quality REITs, great management teams, strong portfolios, and they're all trading at great valuations. Interest rates have been a damper on REITs. But again, remember, the stock market moves before the economy. And with the rate cut environment expected to be on the near term, rates are topping out. We may get one more rate hike, but that's really going to be it. So now's the time to start looking at these value areas, and REITs are a great value right now. Down in the comments section below, let me know what are your thoughts of these 4 REITs that we looked at today. Would you buy all 4 of them? Why or why not? I love to hear all those comments, and I try to answer as many as I can. And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.